Well, good morning, everyone. It's start time. I'm John Deskins, Director of the Bureau of Business and Economic Research at WVU, and I'm really happy to be here for our annual West Virginia Eastern Panhandle Economic Outlook Conference. I'm really sorry that I can't be there in person this year. I've really enjoyed coming out to Martinsburg and out to Berkeley Springs and seeing everyone in person. Hate to miss it this year, and I really hope that I'm back there in person next year finally. But regardless of the fact that we're online, we have a good lineup for this year. We're going to start out with Andy Bauer, who you see on the screen as well. He serves as Vice President and Regional Executive at the Baltimore branch of the Federal Reserve Bank of Richmond. And he's going to start off by setting the context by talking about the national economic outlook. Then I'll come up second and I'll talk about the West Virginia economic outlook and the regional economic outlook over in the Eastern Panhandle. And then we'll close the program with Todd Hooker, who serves as Deputy Executive Director of the West Virginia Development Office. And he'll talk kind of more in depth about specific economic development efforts that are taking place there in the Eastern Panhandle. So it's a great lineup. We'll take up 2 hours or thereabouts, and I think it'll be really valuable. Just to Andy here, I just will say that throughout Andy's talk, feel free to submit questions through the Q&A function that you see at the bottom of your screen. You should see that Q&A button there at the bottom somewhere, and just submit a question anytime. And when Andy's finished with his remarks, my colleague, Brian Lego, who serves as Research Assistant Professor and Economic Forecaster in the Bureau of Business and Economic Research, Brian will come up and he will help kind of moderate the Q&A session to read your questions to Andy. Anyway, I think that's all my announcements for right now. I'll see you in just a bit and I'll pass it over to Andy. Andy, feel free to share your screen there as well, of course.
Sure thing. So John, thanks for having me. And I also wish that we could be out there in person. I also enjoy getting out to the Panhandle. So I'm the regional executive for the Baltimore office of the Federal Reserve Bank of Richmond, and I'm responsible for keeping tabs of what's going on in the Maryland economy, DC, and West Virginia. I get out to West Virginia a good bit. A lot of what we do at the Federal Reserve Bank of Richmond is, talk with people on the ground to get their perspective of what's going on in the economy. And so we have standing roundtables throughout our district. Now, the Federal Reserve Bank of Richmond is the 5th district. That's Maryland down to South Carolina. It includes most of West Virginia. For whatever reason, we don't have the Northern Panhandle. That's the Federal Reserve Bank of Cleveland. We keep meaning to set up some sort of grudge match or something against them to see if we can somehow win that back from them, so we can have the entirety of West Virginia. But our district is from Maryland down to South Carolina and DC and West Virginia, except for the Northern Panhandle. So we have roundtables throughout our district where we meet with business leaders and get their perspective on what's going on with their business, their industry, as well as what they're seeing in the broader regional or state economy. And then we also spend a good amount of time, prior to COVID, we'd go out and actually meet with business leaders at their office. And again, same thing, we'd spend some time. I do it, our bank president, Tom Barkin, he's out doing it as well. Sometimes we'll do it together. And we'll sit down and talk with business leaders and say, again, what's going on with your business, your industry, what kind of perspective do you have on the broader economy? And so a lot of what shapes my view of what's going on in the economy is what I'm hearing from business leaders, as well as nonprofits, financial institutions. Those conversations provide a lot of context to the data that one sees. So I'm going to show you as an economist. I couldn't show up without a number of fantastic slides showing you some of the most recent data, but a lot of what kind of colors my perspective, what's going on in the economy, comes from those conversations with business leaders. And so with that, I'll go ahead and show you my screen if I can know how to do that. I think I do. Share screen. Okay, so hopefully you can see this. Excellent. All right, so Actually, I spent a lot of time trying to figure out what would be the appropriate title for today, just because it has been such an unusual year. And again, it just, you go from one set of unusual circumstances to another. And here we are again, where, the holidays are coming up, but unfortunately, the second wave that people were concerned about through most of the year, we got through the first wave, and then there was concern about a second wave. We had some increasing cases over the summer due to, in large part, what we're seeing in the southern states. But there was concern that there was a larger second wave that would be kind of more widespread, and that's finally happened. And so here we are trying to get a sense of what's happening in the economy now, given these new set of circumstances. And so I settled on looking for certainty in uncertain times. One of the big uncertainties when we went out and talked to businesses was the election. And so no matter who you were rooting for, the fact that there was an election with two very different candidates with two different possibly set of policies that they would like to see put in place, that creates a certain amount of uncertainty. Each time there is, every 4 years when there's an election and there's very different candidates, it's something that we hear from businesses that, sometimes you hear that businesses, they may pause on investment decisions or other activities until they get a better sense of what's going to happen in the election. And that was true with this election, although not surprisingly, as COVID hit and we got into the pandemic, you heard less about that and more about, well, what's going to happen with the virus and how's that going to impact the economy going forward. But then again, as you get closer to the election, the uncertainty about that was something we heard a lot about. Now, I do need to say that the views expressed here are my own and not necessarily those of the Federal Reserve Bank of Richmond or the Federal Reserve System. That doesn't mean I'm saying anything that's not true. It's just a disclaimer that's the bank puts out, because on occasion I might say something which is not entirely, they're all well thought out, but the bank sometimes might want some deniability. But having said that, if I say anything that's brilliant, that really clarifies your view of the economy or anything about life in particular, just know that came from me. So that disclaimer, cuts both ways. So just give you a little bit about an overview. So the economy rebounded a lot stronger than expected following that historic decline in the second quarter. You saw a lot of that was due to very strong policy support, and that's both from the fiscal, the fiscal side, from what things that Congress passed, as well as from monetary policy support. And I'll talk a little bit about that, because one of the issues as we move forward is, let's get rid of that. There we go. One of the issues as we go through the end of the year and into next year is that, is there going to be more fiscal support coming? Because that might have a big impact on certain sectors in the economy. Now, what's been really stronger than expected was what we've seen on the consumer spending, and in particular on the residential side. The residential sector has just been gangbusters, and it's really interesting, especially in the context of the last recovery. And so when we had the housing collapse and the Great Recession, it just took forever for the housing market to really pick up, but really it didn't get to the point where things were remarkably robust. There was always, at least there seemed to be a sense of, even when things got better, much stronger at the end of the end of the last expansion, there still wasn't a lot of risk taking in the housing market. There wasn't a whole lot of spec building, or at least, that's something that I listened to, where, builders were confident that you just build a lot of units, the demand was there. There's issues with inventory and lot and land prices. And so it never felt extraordinarily robust. There was difficulty finding labor, but now that's all changed. And so this year we've seen very strong activity, sales spiking, and I've got some charts to show you that. And going forward, home builders are extremely optimistic about the near term. Now, when I say consumer spending is doing really well, it's really, again, I think one of the, hallmarks or one of the things, one that could really point to is that in 2020, is that the recovery, who's been impacted in the recovery, it's really been unequal, right? There's been a lot of inequities. And you see that both on who really felt the brunt of the collapse in the economy in the second quarter when we shut down the economy, and then how the recovery's been faring. And you see that in consumer spending as well. So spending on consumer goods has really taken off. Spending on services has been much slower. And actually spending on goods like retail sales, they're above where they were prior to the pandemic, where spending is off. And that makes a lot of sense. A lot of spending on services is off. Spending services is a lot of going to be, a lot of services is, is person to person type of purchases. And so obviously people are social distancing. People they're not taking trips. They're not staying in hotels. They're not going to the gym as much. They're not going to personal care services. They're not going to restaurants as much. And so all the spending on services is obviously going to be a lot lower and just hasn't rebounded. And so all those industries, manufacturing in particular, that's related to spending on consumer goods has done a lot better, right? And so other parts of the manufacturing sector have rebounded, but to a lesser extent. Really what's driving a lot of the rebound that we saw in the third quarter was those sectors related to consumer goods spending. Now, obviously we had a huge dislocation in the labor market. Some over 20 million jobs were lost in a month and a half. And the improvement from the unemployment rate, skyrocketed into high teens. But we've seen, again, the improvement has been better than expected, but the losses are still considerable. And so I think we're still short close to 10 million jobs, while we've recovered about half. We've recovered about half the jobs that were lost. And if you think about it, we're still, we lost, so far, we're still down more jobs than we lost during the Great Recession. And so that's, so just think about that for a moment. And again, this is in the context where we're seeing the economy grow very sharply in the third quarter and continues to expand, but we've lost a lot of jobs. And the problem is that, and it gets to the unequal nature of how the economy was hit. It's tough to see the pace of improvement continuing as we've seen it so far. It's much more likely that the improvement in the labor market is going to be slower. And again, I'll talk more about that. But again, it's just based on the unequal nature of how things were hit, and then the outlook for those sectors going forward. Hopefully a vaccine can make all those statements less relevant. But so far, the expectation for the labor market is while we've seen great improvements, it's just going, looking ahead, the improvement might be a lot slower. Now, so for the Federal Reserve, one of our primary missions is monetary policy. We supervise banks. We're very integral in the payment systems. We also have a community development function, but most people know the Federal Reserve for its conduct of monetary policy. Under monetary policy, we have a mandate for maximum employment and stable prices. And so, we closely watch, what's going on in the labor market, obviously, as well as what's going on in inflation. So inflation dropped in the second quarter, and we've seen improvement there as well. But overall, when you look at raw inflation or core inflation, it still remains well below the FOMC stated 2% target. Now, the FOMC has indicated policy is going to remain accommodative, and I've got some charts which highlight the current stance of policy and where the FOMC members think policy is going to be over the next couple of years. There's a lot of monetary policy put in place in order to make sure that financial markets continue to function appropriately. Once the economy was shut down, you saw a lot of volatility in a number of different financial markets. And so a number of different facilities were stood up in order to support the functioning of those markets, as well as, rates were lowered to zero. in order to support the economy in terms of employment and keeping prices stable. Now, again, ultimately, though, what's been driving a lot of people's thinking on this, both at a business level and obviously all of us as we're thinking about the holidays on a personal level, has been what's going on in the pandemic and what's the health policy response. So right now we're seeing, given the rise in cases and hospitalizations, a lot of states are imposing more restrictions on activity, whether it's the size of gatherings, the capacity utilization for different venues like restaurants and others. And so that's going to have an impact on the economy going forward. I mean, so we're really at a kind of at a tricky spot in that we saw huge decline in the second quarter, tremendous rebound in the third quarter, better than expected. But as we went into October and November, things started to slow. And so that pace of the rebound for the fourth quarter, nobody was expecting that to continue. So the question was, okay, what does fourth quarter growth look like? It's going to moderate from the third quarter, but how much? What should we expect? And with the increase in cases and hospitalizations and additional health policy response, that's likely going to slow the pace of growth through the winter. The winter by itself presents a huge challenge for many businesses that have been impacted, because a lot of businesses pivoted over the summer and moved a lot of their activities outside, because we know that activity outside is much safer than indoor in terms of the virus. But with winter coming, that handicaps that strategy. And so, a lot of businesses that were hit hard but were successfully pivoted now face a very challenging winter. And on top of that, there's a question about, is there going to be additional fiscal support for certain industries? And so, as one of the big questions is what is the pace of growth going to be in the fourth quarter and heading into the first quarter with a challenging winter, given the uncertainty regarding the pandemic, health policy response, as well as potential fiscal response or not. Everybody's expecting, it doesn't mean that nobody's expecting, the economy to contract, right? That would fall back into some sort of contraction. But the question is how strong is growth going to be? So that's the overview. It's I just want to show you some of the pictures, because really some of the pictures from what we're seeing are just tremendous. Just to start off with this, for example, right? So here you've got, so the gray shaded areas that you can barely see are recessions. And so you can see there for the second quarter, that's going to be the shortest yet deepest recession in US economic history. So the recession, the economy fell by 31% in the second quarter, but then rebounded by 33% in the third quarter. What are we looking at right now? So, depending on, how you're penciling things in, because we're mid-November, we have some data on October, some survey data as well, indicates that we're looking for, GDP growth for the current quarter to be 4 or 5%, depending on who you're looking at. And so, which is a good quarter for growth. But again, there's still, how businesses are going to be reacting to the virus is going to be important. A lot of the higher frequency data that we look at, just because this thing happened so quickly, particularly in the spring, to try and get an idea of what was going on in the economy, we really needed to get a lot of the data we look at it comes out on a monthly frequency and can be revised. And things were just so fast paced that a number of new data sources came out that people started looking at to try and track how things are going. And so credit card spending data came out that we can look at on a weekly basis, spending at restaurants, hotels, and air travel. And a number of those higher frequency metrics indicated that things started to slow down in October, as well as currently and most recently in November. Again, not contracting, but again, indicating that we're seeing a moderation in terms of overall activity, particularly on the spending side. Now, I mentioned that, what's really been driving the rebound has been consumers. And so if you look at consumer spending on retail sales, So right now, spending on goods is above the pre-pandemic level, and so year to date, spending on retail and food service is up 6% year to date. And so again, so we saw a very strong rebound, particularly on the good side, and it makes sense. A lot of people canceled their vacation and other spending that they would have otherwise put on that they would have used on services. And they're sitting at home and they're looking around their house and they're saying, well, that's, I've always wanted to upgrade whatever. And so they're spending money on furniture. They're spending money on new sports equipment. And you see that both here in the data and from, you see it move not only from the retail level, but back to the manufacturers that are doing very well, who are involved in goods production for consumers. Now, what's been supporting the consumer spending, right? Because I told you that there's a huge dislocation in the labor market, yet consumer spending has been driving the recovery. So there's a disconnect there, right? I'm sure everybody picked up on that. Well, a couple of things happened is that one, as I said, this has been kind of a very kind of bifurcated recovery, like bifurcated economic shock and recovery, because a lot of people could move to remote work, right? So I'm working from home. Other people could work from home. Their incomes were intact. It's just the nature of work for them changed, but they're still working and their income was unaffected. For people in those highly affected industries, tourism, restaurants, all those high touch service type businesses, you saw big dislocations there. But that's when the fiscal support really kind of came in to a tremendous degree. And so we had not only support payments paid out to households and to families, you also had additional benefits, federal benefits for the unemployment insurance that were significant. They were so significant that income, despite the huge job loss in the second quarter, total household income actually grew sharply in the second quarter. So about almost $4 trillion went out to households and businesses in the second quarter. And you can see that here in this particular chart. And so this chart shows you year-over-year percent change in both consumer spending and real disposable income. And so there you can see this huge year-over-year increase in disposable income. And again, a lot of that's from being provided due to fiscal support in the form of extra supplemental payments to unemployment insurance, as well as payments made to businesses that filter through to consumers. To workers and business owners. Now you can see on a year-over-year basis that expenditures fell, right? So whereas I showed you in the previous chart, that's retail sales. So retail sales are year-over-year are up and back to and the levels above where it was prior to the pandemic. This is total spending by consumers, which includes spending on services. And so you can see on a year-over-year basis, consumption spending is down, and that's because services spending is still off, and it's likely going to remain off while we're still in the situation of it's difficult to engage in indoor activities or high touch activities because of concern about transmission of the virus. And that's going to be the case, unfortunately, for the near term. Hopefully, we've had very positive news about vaccines. Hopefully by sometime in the summer, the outlook there could change considerably. So, and as a result of what I showed you in terms of the income payment, the income support through fiscal policy, we had the extraordinary case that the personal saving rate spiked to 34%. And so what is the personal saving rate? Well, so if you take the total amount of income, which is received by households, and that can be through wages and salaries, but it also can be through, supplemental, can also be from transfers from the government. And you take the amount of income and then you look at how much was spent by consumers, what's left over is how much was saved. And then you scale that, right, to disposable personal income, you get the savings rate or the saving rate. And so you can see that it spiked to 34%. And so currently it is at 14.3% in September. And that's really important because, I've talked about how this is going to be, this winter is going to be challenging. We're seeing additional restrictions, improvement in the labor market might be slower. And so all these things could weigh on consumer spending going forward. And again, as I've mentioned, consumer spending has really kind of been driving the recovery. This saving rate is very positive in that it should help continue to support consumer spending through, through the next couple of months and quarters. And so having that saving rate is a nice bulwark to keep consumer spending going forward. Now, on the residential side, residential has just been tremendously strong over the last, since the pandemic started, over the last 6 months, to everybody's great surprise, I think. And I talked to some home builders earlier in the year, and they were very concerned about just, one small home builder in Maryland was very concerned about just getting through the year, right? So they took some of the PPP money that was offered through one of the fiscal support measures, and they were concerned about, if demand was going to be there, were they going to be able to keep their employees and just the overall survival of the business. And then things just turned sharply due to, to a great extent, due to lower mortgage rates, which really increased the ability for people to finance homes. There's a lot of discussion about what's driving the demand for homes. We've seen, what's interesting is that we've seen the demand has been really across price points. One of the interesting things throughout the expansion was that we heard that there's a lot of demand for homes at lower price points, but it was difficult for home builders to deliver at those lower price points just because cost of construction, cost of land, cost of labor is difficult to find people. And so it was really a lot of starter homes. It was difficult to, it was difficult to deliver. But at the same time, so there wasn't a lot of inventory at the lower end of the market, the lower price points. But conversely, at the higher price points, there was considerable inventory, but not as much demand. What's really changed is you're seeing, according to the National Association of Realtors and others, is that they're seeing demand across all price points. And so the question is why is that? We know that there's tremendous demand for second homes a lot across the coastlines, talking to people in Delaware, Maryland, Carolinas. There's a huge, those particular residential markets are extremely strong. Part of that is perhaps people moving from urban populations, which are all of a sudden viewed as less, not a desirable place to be because of the pandemic. Or at the same time, it could be second homes. We know that the second home market has really picked up sharply. And then you see this in new single family sales as well. And so both on existing homes and new single family homes, both strong. And this is why home builders in their latest survey, I think the survey indicated it was the most positive the survey's been in the history of the survey in terms of the outlook for the housing market. And both permits and starts are above where they were prior to the pandemic. And so this market continues to be very strong. It'll be really interesting as we get, at some point, I hope that we get to the question of, so once we have these vaccines, they've been distributed to the population, and perhaps it'd be an interesting conversation. It's tough to imagine it right now, given where we are with the pandemic, that once, because this virus is going to be with us for, going forward, but once it becomes less of a dominant issue, the question of where do people want to live will be interesting, because we've had a lot of conversations both on the residential side and the commercial side. Are people going to want to live in cities like they have up until now? This exodus that we've seen out of certain cities and central business districts by residents and businesses will this stick? Or once you get to a place where this virus is manageable, will there be a return to the cities? And I think that's an interesting question. Now, again, and I mentioned on the manufacturing side, things continue to improve, really strongly driven by what we're seeing on the consumer side. I mean, the auto sector was shut down for what, 6-8 weeks. We just weren't building cars, which was a really tricky time. I mean, just think about that. There wasn't demand for airline, for the aerospace was pretty much shut down. Auto sector, so a large percentage of our manufacturing sector was completely shut down. And so as a result, inventories for automobiles, as well as many other goods, were extremely lean as we entered into the third quarter. And then you had a strong rebound in activity, much stronger than anybody anticipated. Auto sales have been above 16 million units at an annual rate for the last several months. I was closely talking to a number of different auto dealers, West Virginia, Maryland. Nobody was anticipating that. Everybody was trying to guess, well, maybe we'll get back to maybe a 13 million unit rate by the end of the year. And so when things really picked back up, there just wasn't the inventory necessary. And you saw that in prices. And so used cars prices have shot up, and there's just not the availability of units on lots. And normally you have the year-end sales on automobiles, just this year, not what you've seen in previous years, just because of the inventory issue. So, but again, a lot of that increase in activity and just supply issues and inventory rebuilding was being driven what we're seeing on the consumer side. Outside of consumer, it's been much softer. And so if you were to exclude consumer, overall manufacturing still well below where it was prior to the pandemic. Oh, and I should have mentioned, I'm sorry. So this particular chart, they're indexes of manufacturing activity. They ask manufacturers, is activity higher or lower than last month? And they create an index. So for the ISM, which is a national survey, it's if it's above 50, more manufacturers indicating that activity is increasing. And you can see that it dropped sharply to close to 40 during the second quarter, and now it's back up to 59.3. We also have our survey of our district, manufacturers in our district, and as you can see, it's shot back up, and it's higher than it's been, I think, in the history of the series in the most recent month. And then we're seeing business investment pick up on a strong trend as well, which is good to see. Normally, when there's a lot of uncertainty, businesses are a little bit more hesitant. Clearly there's some catch up because things stopped in the second quarter, and so businesses are kind of there's the investment that was put on hold. There's a certain amount of catch up there, and we saw that in the third quarter, but that's continued into the fourth quarter as best we can tell. This particular series is called Core Capital Goods. We exclude kind of non-defense capital. We exclude non-defense capital goods and excluding we exclude defense and aircraft because they can be kind of lumpy and they're driven by large orders. And when you exclude all that, this gives you a nice month-to-month reading of what's going on in business investment, which is a key component of the overall economy. If businesses aren't investing, that gives you pause as to why is that. And so to see business investment rebound considerably is a very positive sign for activity going forward. So I want to talk a little bit about the labor market, because here is where, going forward, things, there's a lot of places where things are doing well, and that's true in the labor market, and you can point to a lot of the areas where things are still sluggish and likely going to be sluggish going forward, and that's in the labor market. Now, I mentioned that that we've had tremendous gains, but we're still down close to 10 million jobs. Here you've got the monthly change in payroll employment that comes out first Friday of every month. You hear about the unemployment rate and how many jobs were the jobs gained or lost in the economy. And so you can hear the latest, the last 2 months, October and September, gains of a little over 600,000, which I should note is the numbers that we look at are just kind of crazy. So if you look in June, it was almost 5 million jobs created in 1 month. Normally that's like half of an expansion. And a typical month, depending on where you are in the business cycle, you're talking about 150, 200,000, 250,000. That would be a good month. So right now, we gained over 600,000 each in the last 2 months, which shows you that we're still in this period of really trying to right size the economy after this tremendous shock, because normally you wouldn't see numbers like this. And so when you just see 638,000 jobs created, net jobs created in October, that is a strong indication that the economy is still trying to get back on its feet from the tremendous shock earlier this year by shutting down the economy. Now, the unemployment rate has dropped much faster than anybody anticipated, including in our shop. When we were thinking about this, we thought it would be a much slower improvement in the unemployment rate. And so you can see the latest number is 6.9%. I should have mentioned before in the GDP chart, these shaded areas, these are the projections by each of the FOMC members. So 4 times a year, my boss, Tom Barkin, and all the other members of the FOMC, they'll submit projections for what they think is going to happen with GDP, the unemployment rate, inflation, and short-term interest rates over the next couple of years and in the longer term. And so here are the projections from the September meeting. And the red dot's kind of is the median, and the gray is kind of what we call the central tendency. And then the entire blue part encompasses all the entire range of views from the FOMC. And as you can see, there are a couple of things that are notable in that the FOMC is anticipating a continued downward trend in the unemployment rate. But I think what's also notable is if you look at the end of, so this is for the fourth quarter of each year. So if you look at the fourth quarter of 2021, look at the size of that range amongst the entirety of the FOMC. That is a huge range. Ranges anywhere from 4 to 8%. So there's still a lot of uncertainty as to what's going to happen in the labor market, because again, there's a lot of issues with the nature of the shock, who was hit, and how well they can recover. And that a lot of it depends on what's going to happen with the virus itself. We know that there's a lot of industries which are still essentially shut down. Think of the entertainment industry, think about hotels and travel. They're not exclusively shut down, but they're operating at a fraction of the capacity that they normally would. And so they require a fraction of the workers. And so you have all these workers in these affected industries for which there are currently no jobs available, unless you see a rapid turnaround in the virus such that allows these activities to continue again. These people don't have, their opportunities are extremely limited. And at the same time, what's interesting is when you talk to businesses, a lot of businesses have a hard time finding workers, right? And so you have this odd situation where the unemployment rate has been high, remains elevated. And so you've got all these people who are unemployed, but at the same time, you've got a lot of businesses that can't find workers. And unfortunately, there's just this mismatch between the skills of the people who are unemployed and the skills that are needed by businesses. And that's something that you just can't fix overnight. And so, that's going to be an issue. And there's also a regional, spatial issue to this as well. So, and then another factor on top of this is that, decline in the unemployment rate to 6.9%, that's great, but it really kind of overstates the improvement in the labor market. Now, the unemployment rate is a really good gauge for understanding kind of the general trend and what's going on in the labor market. But, the unemployment rate is the number of unemployed scaled by the labor force, which is employed and unemployed. But here's the thing, if you drop out of the labor market, so you're not working and you're not looking for work, so you're not categorized as unemployed, you're not factored into this particular metric. And what we've seen is a huge fall off in the labor force participation rate. And so you can see that it was north of 63 prior to the Great Recession. Here we are under 62. So we dropped a considerable amount in a short period of time. And so even though I've talked about all this improvement, great growth in the third quarter, good gains in terms of the decline in the unemployment rate, a good amount of that's being driven by people having left the labor force. Now, why have people left the labor force? And it could be the case that some of these people that have lost their jobs that just don't have opportunities because there are no other opportunities given their skill sets. Could be where they're located. But another issue just could be things like childcare. Right now, many school districts across the country, including my own, they're completely virtual. And so somebody has to be home with the kids. And we think that that's driving a good bit of the decline in the labor force participation. This is particularly notable for women. The women's labor force participation has dropped sharply. And so just based on traditional factors, it could be the case that the reason why their labor force participation has dropped so much is because of childcare issues and the fact that schools at this point are virtual. And again, until that we can figure that piece of it out, until kids are going back full time, that's likely going to weigh on the labor market. Now, I just want to get to lastly to talk about inflation and then policy real quickly and take some questions. So inflation, I mentioned that inflation dropped in the second quarter, and what I mean, it didn't outright decline into negative, but it softened considerably. This is overall inflation, but you saw with core inflation as well. And so right now we're at 1.4%, and that's expected to increase moderately over the next couple of years. And this is, again, so I've got the FOMC projections. This chart actually is really kind of notable in that it's not until the end of 2023 that the FOMC is expecting inflation to get back to target, right? And so if you looked at this chart in years past, given the appropriate monetary policy, FOMC members believe that inflation will return to target more quickly. So given the severity of the decline, and then given that, inflation it's been stubbornly low for the last, 12 years, you can see this in the chart, it's more likely to be below 2% than above it. So, inflation moves, it's been stubbornly low. We've had this huge contraction, there's a lot of sectors which are still underperforming. You've got gaps in terms of capacity utilization's low. And so it might be some time for inflation to pick back up again. And so that's going to have big implications for monetary policy. So as I mentioned before, the mandate for the Federal Reserve is maximum employment and stable prices. And so I've showed you that while the unemployment rate's coming down fairly quickly, currently it's above anybody's estimate of, it's far below where we are in terms of the labor market. The unemployment rate's far above what anybody would consider near, something close to maximum employment, especially if you factor in the drop in the labor force. And at the same time, you see that inflation's low and expected to stay low. And so, and for both those reasons, currently the main policy tool of the Federal Reserve, which is the federal funds target rate, that's at 0, and the FOMC has indicated that it's likely to remain near 0 for the near term because of what they're seeing in the labor market, and because of their expectations for inflation in the near term. And that's this last chart here, which shows you the, again, this is each dot represents an individual FOMC participant's judgment of what would be appropriate for policy. And now each dot is for the fourth quarter of each year. And so if you look at 2020 and 2021, each of the members of the FOMC, and again, that's the 12 Reserve Bank presidents, as well as the 7 governors at the Board of Governors. So each of the participants believe that the federal funds rate will remain currently where it is, near 0 for this year and next. Most believe that it'll stay at that level for 2022 as well. There's one member that believes that the rates will start increasing by the end of 2022. And then you have 4 members expecting in 2023 that it would be appropriate to start raising rates. And you can see in the longer run, once the economy is operating near potential, you're getting good economic growth, inflation's near target, the unemployment rates around some level associated with maximum employment. At that point in time, FOMC members would think that what would be appropriate for the federal funds rate would be something in the order of about 2.5%, something between 2 and 3%. But as you can see, it's going to take some time given the outlook for the labor market and what we're seeing in terms of on the inflation side. So just to sum up, and then I can take some questions. Again, we've had a much better rebound in the third quarter. Really, though, it's not been uniform. And so households, I didn't really get into the inequity in terms of which type of households have been hit. Those that have been impacted in the service sector jobs are also those people that those incomes are on the lower end of the pay scale. And so really, it's been disproportionately felt by those lower income individuals. Also, more likely also felt by more communities of color. The health policy response in terms of closing schools, that has also had a big impact on those households as well. There's less flexibility in terms of working from home, less flexibility in terms of alternative childcare arrangements. And also because that are necessary because often in these cases that they're actually working essential jobs and actually need to be at the job site. So going forward, we're just looking at the fourth quarter. We're expecting growth 4 to 5%, but really, what people are looking at closely. What's going to be the impact of the rising cases and hospitalizations, and as a result, the new healthcare, the health policy responses in terms of restrictions on certain activities, and in terms particularly on capacity utilization for the capacity that businesses can operate at, and restrictions on other activities. So what kind of impact will that have on the economy? And then just winter is coming. Those businesses that have been pivoted, how are they going to weather an environment where they're no longer be able to utilize the outdoor for business activity? There's a lot of concern that if there isn't additional fiscal support, we haven't seen as many business closures as was initially feared, in large part because of fiscal response. So are we going to see that this coming winter? So that's a concern. Having said all this, the vaccine, we've had very good news about the prospects of a vaccine in 2021. We've got 2 vaccines with a high rate of effectiveness. And so should we get that distributed widely, and that's, from what I understand, that would be likely to the general population sometime by, early or midsummer, that obviously that would completely change the outlook for the economy. And I'm curious to see how people would respond once, the overall general concern about the vaccine is felt like it's more manageable, or gosh, I don't even want to, it's tough to think about having it behind us. I would love to have that thought that, the vaccine this particular virus is completely behind us, but at least let's go with manageable. I would love to see how consumers and businesses react in that environment. So, following the Spanish influenza, 1919, we had the Roaring 20s. And so curious to see how our economy would respond, or the world economy would respond once this is lifted off of our shoulders. But until we get greater clarity about this uncertainty, it's just going to be a challenging environment. I think it's going to be a challenging couple of months, a challenging winter. We'll still have growth, but it's just going to continue to be uneven, and you're still going to have losses in certain sectors. And with that, be happy to take any questions.
Okay, Andy, it looks like we only have one in the Q&A section, but I think it's a pretty good one. The labor force participation rate began a consistent decline since the housing crisis and Great Recession, and stayed low even before the pandemic took into effect. So why is that, and will we ever see it rise to pre-2008 levels?
Yeah, so there's two metrics, the labor force participation rate and the employment to population ratio that we follow, that are closely followed. And so, I mean, part of it was following there's a couple things that people focus on. One was it took a very long time for a recovery in the prime age labor force participation or employment to population rate for prime age males. And so you saw a huge dislocation in terms of, particularly in the housing sector, and to a lesser extent in manufacturing, which are both sectors which are predominantly primarily driven by employment for males. And so that was a factor following actually really after 2000 and 2008. You really saw that particular portion of the labor market really be affected. And so there's some interesting work which has looked at the impact of trade on the manufacturing sector and in labor force participation. And it looks at it regionally, and it looks at the impact of manufacturing related sectors and how that's impacted certain groups. And one of them's been prime age males. And so their labor force participation has actually been declining. It finally stabilized close to just before the pandemic. Stabilization, as if I recall, it actually started to tick up. Another factor, which was what's been driving throughout kind of in previous decades, what really was driving the increase in the labor force participation rate was more women entering into the workforce. But then we saw that plateau around 2000. And then it started to decline a little bit. And so there's some question as to why that was the case. If you looked at other countries like Canada, for example, you didn't see that decline in the labor force participation rate of women. They continued on its upward trend. And so the question then becomes is, what's going on there? Does it have to do? And so again, there was some work looking at that. Perhaps it was childcare. But between the two of those things, you just had this it took a long time for the labor force participation rate to stabilize following the Great Recession. And then we were so what we were looking at, particularly with the employment to population ratio, it was actually picking up in the last couple of years right before this hit. And it's unfortunate because a lot of the gains that we were finally seeing in a very, just a couple of months, I don't want to say they were wiped out, but all those gains, you saw were reversed. So let's go with reversed because they could reverse again, and we could see people coming back into the labor force under the right conditions. But again, the challenging thing obviously we've got certain sectors of the economy which remain essentially closed. I like going to the theater. We all like going to movies. We all like to travel. We like, I'm not sure how much we like getting on airplanes, but we like going to places on airplanes because of the destination. And a lot of that's just shut down to whatever percent. And as a result, those people employed in those industries are out of work and don't have a lot of options. And so their labor force participation is going to be challenged for the foreseeable future until we can get, this virus managed or ultimately behind us. And then on the same time, and more immediately is, the school issue is just huge. I mean, everybody, for those people with children, that somebody's got to be home. And so that's definitely impacting the labor force for the immediate term. And so getting kids back to school, but not just for the labor force, but just for kids themselves. There's a lot of research which shows that, having kids out of school is not good for a variety of different reasons, both in terms of, their own education and acquisition of what we call human capital, or just, there's others, social, negative social impacts as well. And so I think that the school issue is a big one for kids and for the labor market.
Okay, we have time for one more. This question concerns the housing market, and it asks, is there any indication in the growth in the housing market that's occurred that lower priced housing inventory is being rebuilt to address the affordable housing crisis?
So right now it's very tricky in that, even before this, land prices were high. And so it made it very difficult for home builders to deliver at lower price points. I've talked to home builders that said, look, we know the demand is there. I would love to be able to deliver, homes at lower price points, particularly for the starter homes, but just because of cost of materials, cost of land, just the land availability, it just made it more difficult. And so inventory, right now, I think inventory levels, wanted to look it up this morning before, so I could actually give you the actual number, but inventory levels are extremely low, and they were prior to this. And so thankfully, because mortgage rates are a lot lower, the affordability of homes has improved. So, according to National Association of Home Builders has an affordability index that's improved in large part due to lower rates. But it's still the case that it's on the pricing side in terms of the construction of the home. Right now, lumber is extremely expensive, and so that's making it challenging to deliver homes at a lower price point. And the land availability issue is still an issue. And a lot of that has to do with local land use regulations. Again, the National Association of Home Builders has done some studies where they've surveyed home builders. They've looked at the cost of building a home, and and what they found is a lot of the increase in home prices. Well, a considerable amount of the increase in home prices, according to one of their reports, really kind of reflected increase in regulation as opposed to increase in cost of materials and other things. In those places where there's a lot of research and economics on housing, and in those places where there's a lot of land availability, not a lot of land use regulations, the cost of building the home really reflects just the cost of materials and labor. You get this big kind of wedge or delta between the cost of delivering the home and the market price. A lot of that reflects, and again, I'm not saying that, so a lot of these regulations make a lot of sense in terms of smart growth policy, stormwater management, environmental issues. And so, communities to varying degrees have these regulations in order so that they can grow their community in a way that makes sense. But the net of that is that in many places, it makes land more expensive or less available. And as a result, it drives up pricing.
All right, Andy, we're over time, but we have one more question. I know Brian just said one question ago, but we have one more question. And I think it's a really good question, so I'm going to squeeze it in here just really quickly because I like the question. So here we go. I own a restaurant. I've had a terrible time hiring people and have attributed that to the previous unemployment of $600 per week, which is much more than I pay. Do you think that if another stimulus is approved, they will look at that closer so as to not encourage those workers to remain unemployed?
Yeah, that's a great question. We heard a lot about this. And so, it's, the Congress, I know we're over, but it's remarkable how quickly they passed some of the fiscal support. And so for like the PPP, that was passed and implemented in a very short period of time. And for many businesses really got them through. It was a lifeline that without that, they wouldn't have gotten through that. Part of that package also was supplemental wages for those that are unemployed. Again, the idea was really, we knew this was going to be very difficult for families. We need to provide adequate support. The downside is exactly what you mentioned. We heard from many businesses that couldn't find workers, particularly in the restaurant industry, where again, because they were competing against the supplement. What we've heard is they're very aware of that disincentive to work and how that's been a problem. And so from what, again, and these are my own views, and I don't have a crystal ball as what they're doing just down the road in Washington, but I know that, everybody's keenly aware of the disincentive to work that additional stimulus payment was created. And so my understanding is that there is going to be more thought put to that as they weigh the competing benefits of, one, making sure households have adequate support in a time where it's difficult to find employment, versus versus making sure that you don't create this disincentive for people to go out and work again.
All right, Andy, thank you so much. I really appreciate that. That was a really rich and valuable presentation. I really appreciate it.
Sure thing, John.
Now,
thanks. Yeah.
I always appreciate you having you on. And again, hopefully it'll be in person again next fall. No more online.
Yeah. I can't underscore how much I hope as well.
All right, I'll get right into it. I'll switch it over to my screen share. All right, I've got mine set up now, so I'm good to go. So I'll get right into it. Here's kind of the key takeaway, just in case you have to run early or something like that. Here's my conclusions. First and foremost, here in West Virginia, we suffered the fastest economic collapse in modern history. We've seen economic collapses like this before. If you go back to the early 1980s, or if you go back to the Great Depression of the 1930s, we saw economies that were just as bad, but never has it happened this fast. Totally unprecedented. But the recovery has been stronger than I would have expected. If you went back to May 1st, and if you ask me how strong would I expect us to be by the end of summer, I probably wouldn't have forecast an outcome that was as good as what we actually observed. So I think the recovery has been stronger. Although that said, the recovery was faster earlier in the summer. Now the recovery has slowed down here later in the summer, and now that we're into the fall. So the patterns there that we're seeing are similar to what Andy talked about nationally. So West Virginia as a state isn't deviating in terms of that big picture progression. But even though we've had a fairly strong recovery, even though I've been pleased with the progress so far, we don't think the economy is going to fully recover until sometime in 2022. Again, the recovery is kind of slowing down as we get closer and closer to where we started out. So I think it's going to really take another 1.5 of this year. I will say we face continued uncertainty. The amount of uncertainty that we saw back in March and April was truly unprecedented. I don't think there's ever been a time in economic history that we've had as much uncertainty as we saw back in the spring. And that uncertainty has abated, of course, to some extent as we've kind of learned to cope with the virus, and as we've opened back up, and as we've adopted some of these measures that allow us to kind of confront the virus to some extent. But we still face so much uncertainty, and that makes it a lot more difficult for somebody who's trying to forecast where the economy is going. So this is a tough time to be an economic forecaster. It's kind of my point there. And throughout this talk, I'm going to focus on primarily kind of the short term, right? I'm going to focus on what the virus has done to the economy and how we expect to recover over the next couple of years. But I just want to mention, for those of you who've heard me speak before, in West Virginia, we have a lot of long-term challenges, and those haven't gone anywhere. So even though our focus has kind of returned to getting back to where we were in January, those long-term challenges are still there, and we shouldn't just give up on fixing those. We still need to keep those long-term challenges in mind. And so I'll mention that to some extent as well through this talk, even though I'm going to mostly look at the short-term fluctuations. We'll just start off by surviving this COVID pandemic. It's been a devastation to our economy, so this will be our focus to start with. Here's the picture that kind of takes your breath away. Look at that. West Virginia lost 94,000 jobs over the course of March and April as a result of this economic crisis. 94,000 jobs. You see kind of what that does to the overall jobs picture. That took us back to the level of employment that we had somewhere back in the early 1990s. Obviously, that's not shown in the figure. We have to go back nearly 30 years to see a level of employment that low. Overall, that amounted to about 13% job loss in our state. It was a real punch in the gut, to say the least. And you can see just how fast it happened. But on a positive note, we've gained back about 57,000 jobs by the end of the summer, as the lockdowns ended and as the economy started to recover. So we lost 94,000. We've gained back 57,000. We still have 30 or 40,000 yet to go before we get back to normal. So pretty sharp recovery so far, but you can kind of see even in the figure that it's starting to taper off a little bit, and that continues in a little bit more recent data that hasn't been put into the figure. I will note, though, before I move on, look at 2019. 2019 was actually kind of a rough year for West Virginia. We lost jobs over the course of 2019, even before this crisis hit the beginning of this year. The loss of jobs there was mostly driven by a loss of natural gas pipeline construction jobs. Our state was really getting a boost from natural gas pipeline construction. Those are good, high-paying jobs that really benefit the economy in various ways. But several of those jobs just ended naturally last year. And so our economy was kind of already on a downward trajectory over the course of 2019 for that kind of external reason before the crisis happened. Now here's a crazy figure. The blue bars show you the loss in employment that we suffered in West Virginia, the 13% job loss that I mentioned a second ago, the 94,000 jobs translated into 13%. And then you see the job loss, similarly in the nation and in several of our neighboring states. Then the yellow bars show you the jobs that we've gained back since the economy started improving there sometime in May. So this is the crazy part. We lost 13% of all of our jobs in West Virginia. But believe it or not, it could have been worse. It was 14% nationally. And there you see in some of our neighboring states, Ohio, Kentucky, Pennsylvania, their job loss was even worse, up to 18% job loss in Pennsylvania. So never would I have imagined that I would say, well, 13% job loss, it could have been worse. But that is the case here with this and as many states. And then furthermore, we've gained back 9% of our jobs since we started growing again. And that 9% gain, it looks good as well. It looks better than what we see in Virginia, Maryland, the nation, or it's equal to what we see in Ohio. So West Virginia fared relatively well, even though we were hit so hard. Here's kind of a similar story. Here we see the unemployment rate. We see the unemployment rate for the nation, and then for the state, and then there for the nation in comparison in yellow. West Virginia, our unemployment looked pretty good before the crisis hit. We were down at just under 5% unemployment in the state before the crisis hit, and by any historic standard, something under 5% looks pretty good. But the unemployment rate skyrocketed up to 16% over the course of a 2-month period. Really, again, unprecedented. We've seen 16% unemployment before. We even saw something like 25% unemployment during the Great Depression, but for it to happen over the course of 2 months is unheard of in economic history. But again, we've seen pretty good improvement. The unemployment rate has now fallen down to below 9%. So we've come a long way back to where we started, coming back down to less than 9% from a peak of 16%. And this is kind of the same story. The blue bars show you the increase in unemployment that we observed when the economy was in recession. And then the yellow bars show you the improvement in the unemployment rate that we've seen as the economy has been recovering. And so we suffered an 11 percentage point jump in unemployment here in West Virginia. And as you see, that wasn't as bad as what we saw nationally. It was 11.2% nationally, so just slightly higher. And the jump in unemployment was also worse in those neighboring states of Pennsylvania, Kentucky, Ohio. So again, kind of the same story. We weren't hit quite as hard as what we saw in many of our neighboring states. Now this shows you the job loss by sector. There at the bottom, you see the total job loss. So the blue bar at the bottom shows you the 94,000 jobs that we lost altogether. A recession added back as the economy has been recovering. And then you see, furthermore, the point of the figure is to see how that job loss stacks up across the different parts of the economy. As you see, leisure and hospitality and trade were the hardest hit parts of our economy, and that's no shocker. Leisure and hospitality, that's where you see those restaurants and bars that were just flat out shut down and that were really hard hit. That's the leisure and hospitality sector. So we lost 39,000 jobs in that sector. And then trade, that's where we have a lot of the retail establishments that were closed down and that were impacted by the crisis. We lost, as you see, almost 13,000 jobs in the trade sector. The third hardest hit sector, I just will note real quickly, is education and health. Education and health is mostly health, because that just includes private education, and we don't have a whole lot of private education employment in West Virginia. So it's the health sector. And health was the third hardest hit because, as you recall, kind of elective medical procedures were shut down for a long time. So elective stuff in the doctor, the dentist office, the eye doctor's office, things like that. If it wasn't an emergency, it was shut down. So that sector was pretty hard hit. But every single sector in West Virginia lost jobs. As you see, the blue bar goes to the left for every single sector. And almost every single sector has recovered to at least some extent since the economy has been improving. So that's good. The only sector that has fully recovered, I know Andy mentioned manufacturing before. Nationally, the only sector down to this level, manufacturing, has fully recovered, but all the other sectors have at least some remaining ground to cover. Here's one more kind of short-term statistic that I have focused on during this crisis. This is the number of people who are on unemployment insurance benefits. This, of course, ties into that question that we got there at the very end of Andy's talk about unemployment insurance benefits and how it might affect participation in the labor force. But there you see, we were down at about 17,000 people were on unemployment insurance before the crisis hit. That was kind of our norm there for a few years before the crisis hit. And the figures absolutely skyrocketed up to 146,000 by the time we got to the latter part of April. So going from 17,000 people on unemployment insurance up to 146,000, totally incredible. But you see the number has improved steadily. And right now we stand somewhere in like the mid 30,000 range. So you can kind of take it glass half full, glass half empty. The glass half full part is clearly, as the figure shows, on the downside, we still have about twice the number of people on unemployment insurance that we would normally have. So, you can kind of think of it either way. And I just will say, I'm going to have Todd Hooker come up here after me here in just a few minutes to talk about economic development efforts that we have going on in the state, especially economic development efforts through the West Virginia Development Office. But, he'll talk about this more, but I just want to mention that, even though we've suffered a crisis, even though this has been an unprecedented period of economic history, I just will say that, we've still been pushing forward. We've still seen some gains. Overall, you see 400 plus jobs created through the Development Office this year, nearly 1,500 jobs retained through the Development Office through their efforts this year. And at the bottom there, you see I have a couple of examples listed. For example, over in your neck of the woods, we have the Clorox facility coming into town there in Berkeley County, adding 100 new jobs. Some things I don't have listed. We have expansions, beyond what was announced previously at the Procter & Gamble facility. We have other stuff going on as well. So even though it's been a crazy year, we still have some examples of good things happening in our economy despite the overarching crisis. Now I'll talk about the Eastern Panhandle a little bit here before I move on to our economic forecast and before I move on to other topics. As you all know, I think you all are kind of familiar with my approach, and this is pretty standard, but I'm defining the Eastern Panhandle as these three counties, and they're just for your information, there's the number of jobs in each county. Now this figure just shows the number of jobs in the county. This does not account for people who live in the county and who work out of the state. That's a really big issue for Jefferson County especially, but this is just showing you the number of jobs in each county. There you see how they vary in size by this metric. And then here's kind of a similar picture that I showed you earlier. the total employment in the Eastern Panhandle now than I have the state overall there for comparison purposes. Just as background, you can see the steady progress that I think we should be proud of in terms of economic improvement in the Eastern Panhandle over the last decade. Then, of course, the crisis hit, as you see there. The Eastern Panhandle lost about 7,500 jobs during the crisis. Again, 94,000 jobs in the state altogether were lost, but in the Eastern Panhandle, we lost about 7,500 jobs. And the percentage decline was close, right? We lost 13% of the jobs in the state. In the Eastern Panhandle, we lost 12-point-something% of the jobs. So it was pretty similar in terms of the decline, a little bit less. And we've gained back 3,000 of those jobs in the Eastern Panhandle as the economy has been recovering over the summer and now into fall. So kind of a similar pattern in the Eastern Panhandle, just in terms of the overall magnitude of the job loss. On the other hand, the unemployment rate in the Eastern Panhandle is much stronger. Unemployment rate is really incredible over there, actually. Unemployment was down to 2-point-something% in the Eastern Panhandle before the crisis hit at the beginning of this year. That's, as you see in the figure, that's much lower than national unemployment, or that's much lower than state unemployment, and that's even lower than national unemployment. The national economy was really strong in terms of unemployment at the beginning of the year. Eastern Panhandle was even yet stronger. But in the Eastern Panhandle, the jump was up to 12%. Unemployment went from 2-point-something% up to 12%, but it's recovered all the way back to 6% already. It's just, I mean, these data just reflect the end of the summer. I know it's November right now, but as of the end of the summer, unemployment was already back to 6% in the Eastern Panhandle, and that's good. I mean, it's, you know, we still have some ground to gain to get back to where we were, but 6% unemployment is better than what we see nationally, and it's significantly better than what we see statewide. So that's something to be happy about. As Andy mentioned before, with discouraged workers and with people leaving the labor force, the unemployment rate isn't completely accurate. It's not the only statistic to consider during an economic crisis like this, but it's still showing you know, a good indicator there. So it's something to be proud of, that improvement in unemployment down to 6%. All right, before I go on to the forecast, I do want to, I'm going to pause here because now I'm kind of switching gears and I'm leaving a short-term discussion, which I've been focused on the short run. I've mostly been focused on the fluctuations that we've seen this year. And now I want to focus on one of those long-term issues that's kind of that's an issue that takes a decade or more, probably more than a decade to address. It's the issue of labor force participation. You know, unemployment, as Andy said before, unemployment captures, you know, among everyone who wants to have a job, how many people actually have a job versus how many people are just looking for work. But this is the more fundamental statistic. This is more fundamental, more underlying compared to the unemployment rate. This is the labor force participation rate. This statistic captures, among the entire adult population, how many people want to work in the first place. You know, never mind whether they have a job or whether they're just looking for a job, but how many people want to work in the first place. Nationally, it's 63%. You know, there was a question before for Andy about how that 63% is noticeably lower than it was 2 decades ago. That number was closer to 70% 2 decades ago. But anyway, that's not the point here. The point is, nationally, the labor force participation rate is 63%. In West Virginia, is dead last among the 50 states at 55%. Most telling statistics for the West Virginia economy for the long term. We can never achieve the economic prosperity that we hope for if we have 8% of our adult population on the sidelines compared to the nation. We can never achieve the economic prosperity that we hope for unless we can get more of our people in the workforce, unless we can get that blue bar to move to the right. And the reasons for this deficit are related to human capital. You have people who just don't have the education and training and workforce preparedness that they need to get a job, so they don't even look for a job in the first place. They'd like to work in a perfect world, but they know they're not going to get hired because of education, training, problems, deficits, shortcomings, so they don't even bother to look for work, so they're not even in the labor force. Another issue is also related to human capital. It's health. Kind of the same story. You have people who would like to work in a perfect world. They don't even bother to look for work because they know they have some health problem that prevents them from working. And the third issue is drug abuse. Same story. You have people who would like to work in a perfect world. They don't even bother to look for work because they've managed to get caught up in this horrible, tragic issue that we have with drug abuse. So to achieve full economic prosperity in West Virginia absolutely requires us to get more people in the workforce. It requires us to get that blue bar to the right. And to do that, we have to find effective ways to improve education outcomes, to improve job training, to improve health outcomes, and to improve this drug abuse crisis, to help fight this drug abuse crisis. Now here, the yellow line shows you the labor force participation rate for the Eastern Panhandle counties specifically. I will say Morgan is, in Morgan County, we have a labor force participation rate that is above the statewide rate, but it lags the nation. But in Jefferson and Berkeley County, we're actually kind of superstars over there. The labor force participation rate is actually state, but it's actually even a little bit higher than what we have nationally. So Berkeley and Jefferson are real superstars in terms of having their people in the workforce. So this issue isn't as important in the Eastern Panhandle. I mean, this is an absolutely crucial issue in some parts of West Virginia. It's not as important in the Eastern Panhandle, but I think it's still important enough that it deserves mention over in your part of the state. Anyway, moving on, where do we go from here? Now I'll talk about getting us out of this crisis. All right, here is a stylized diagram just to kind of help you think about possible economic recovery scenarios. This is actual data on the left half of the figure, but the data in the gray are just made up just to give you a sense. So we kind of have four different kinds of recoveries. The most pessimistic is what we call an L-shaped recovery, the green line there at the bottom. And an L-shaped recovery is a misnomer because it's no recovery at all. It's when the economy falls into recession and then it just keeps moving along basically at that low level of employment that emerged at the bottom of the recession. Again, it's not a recovery, so it's a misnomer to call it an L-shaped recovery, but that's what you hear in the media, so that's what I'll use. I heard some pessimists back in the spring calling for an L-shaped recovery, right? The negative Nancy's that we have among us were calling for an L-shaped recovery. I didn't think that was going to happen, and the data already have been strong enough to indicate that we're not having an L-shaped recovery. The next kind is what we call a Nike swoosh shaped recovery. What we have here with their graphic design, it looks more like a check mark, but I'm calling it a Nike swoosh because that's maybe slightly a cool name. I don't know. I don't like Nike myself, so I don't think it's cool, but young kids like it at least. A Nike swoosh-shaped recovery is kind of the next most pessimistic scenario in some sense because it just means a slow, gradual recovery. Takes a long time to get back for the recession. Best kind of recovery, the blue line, is a V-shaped recovery. It's when you fall into recession quickly, but then you make a pretty quick recovery. I will say, our forecast is calling for a V-shaped recovery. And the very fact that we've added back 57,000 jobs already, that already rules out the L-shaped scenario, that already rules out the swoosh-shaped scenario. We're already into a V-shaped recovery, and we're calling for a V-shaped recovery. Now, it's not going to be a perfect V-shaped, right? It's tapering off. It's not straight down and straight back up. It's tapering off, but we're moving in that direction. So that's a good thing. I think your forecast is overall pretty optimistic. But now the curveball is the W-shaped recovery. And I will say this. Here's kind of my disclaimer that I should have mentioned a second ago. Right, with a recession, normally the recession, you know, arises from some problem in the economy. That's not a shocker. And so economists study that problem. Economists study how the economy has responded to that problem, and we make a forecast based on how the economy is going to recover coming out of the problem that emerged in our economy. That's kind of a straightforward idea, right? We have an economic problem. It puts us in recession. We try to understand that problem and make predictions. But the issue here is that the beginning of the year, our economy was stable. Right? We didn't have a problem in our economy. I mean, we had long-term challenges, like I said, with human capital, et cetera, but there wasn't a short-term crisis on the horizon, right? This recession is unprecedented in that the recession came out of left field, and it came out of this issue with public health, right? The recession, an economic recession, was caused by not an economic problem, by a public health problem. So the fact that the recession is stemming from public health, the fact that I have no training whatsoever in public health, the fact that virtually no economist that I know of has any training in public health, makes this an especially difficult time to forecast the recovery. So that takes me to the yellow line, the last option. That's what we call a W-shaped recovery. It's when something else happens, some other crisis emerges, and we fall right back into another recession. It used to be called a double dip recession, but for some reason in the last few years, people have started calling it a W-shaped recession. Again, we don't think this is going to happen, right? We see that the fact that we're getting more comfortable with social distancing and masks, and we see that we are we're able to respond to the virus more effectively now than we were in the spring. And of course, we have the vaccine news that has been very good news in the news lately. But at the same time, we see these virus counts have completely exploded over the last 2 weeks. So we have more uncertainty. And as I said before, this is just a time of incredible uncertainty to begin with. So W-shaped recovery is the last option. We're not calling for that, but it's impossible to know for sure in this unusual economic environment. Bottom line is we're calling for a V-shaped recovery. And now here's the actual forecast that we're putting forth. Again, we're already kind of part of the ways into that V with the 57,000 jobs that we've added. We think it's going to get slower and slower as we go further into the future. But overall, this recovery is going to have a V-shaped according to our best guess. That said, it's still going to take until 2022 to fully recover back to where we were at the beginning of this year. So it's going to take all of 2021, then a little bit more time to get back to where we were. Normally we just give one forecast, but in this case, with the uncertainty, we've kind of taken into account other assumptions to provide kind of a more of a range of a forecast. So the green line shows you what we believe is kind of the best case scenario under kind of reasonable assumptions. And then the red line shows you what we believe is the worst case scenario under reasonable assumptions. If the optimistic scenario actually plays out, well, we could achieve full recovery by the middle of next year, by the middle of 2021. Okay, so the recovery could basically happen a year quicker if the most optimistic scenario plays out. On the other hand, if the most pessimistic scenario plays out, then it's going to take us a while. We're not even going to recover fully in the entire 5-year forecast window under the most pessimistic assumptions that we think fall within the realm of reasonable. But I also want to draw your attention to the latter part of the forecast period, right? Even though kind of my main point here is that we're going to recover by sometime in 2022, we do expect there's going to be some long-term sluggishness in the West Virginia economy. Once we get back, we think those long-term challenges are going to reemerge with regards to our demographics, with regards to our industrial diversification, with regards to some issues in energy and in natural gas pipeline constructions and the end of those natural gas pipeline construction jobs. So we think we're going to have some stagnation in the longer part of the forecast period. So that means we still need to not just worry about getting back to normal. we also need to worry about those long-term economic development efforts that were in place before the crisis and that need to continue to be in place even during this crisis. Here's the unemployment forecast, kind of the same story. We expect unemployment to recover back to that roughly that 5% level by sometime in 2022. But there you see how the time period can vary under what we consider to be reasonable assumptions. So basic idea. Now here's a sector by sector analysis. You have the total there in the middle. And so you have the baseline forecast that we're calling for. Then you have how much growth could we have under the most optimistic or under the most pessimistic scenario, the green line. And this is a 3-year window. I'm actually doing a different time period here just to illustrate a point. But over this 3-year window from 2020 to the beginning of 2023. So the baseline is, you see, we're calling for growth overall over that period. And under the most optimistic scenario, we could have growth of up to 2%. But look at the bottom sector there, not government, but the next to the bottom one. There we've combined the retail sector plus leisure and hospitality. That's the sector that's been the hardest hit, as I mentioned before. And we expect under the baseline scenario that retail and leisure and hospitality combined will still be down more than 2% by the beginning of 2023. And under the worst case scenario, that group, that combined sector, could be down by nearly 8%. We think that even under the most optimistic scenario, retail plus leisure and hospitality are only going to be up just a little higher. So that sector is not doing well. That's in part because of national trends, and it's in part because of the way in which it's been affected by this crisis. On a more positive note, you see the growth that we see there with manufacturing, with health, with natural resources and mining. Those sectors look much better according to our baseline or our optimistic forecast, but then you can also see how much kind of variation there is in terms of how unemployment, or rather employment, will ultimately unfold in those sectors. Here's the Eastern Panhandle specifically. The blue bars show you the actual growth that we've seen over the past decade in terms of the number of jobs, and the yellow bars show you the growth that we expect going forward. I've got good news for the Eastern Panhandle, especially those you folks in Jefferson County. You guys are expected to do really well. Jefferson County has been doing well, right? Growth in Jefferson County over the past decade has been just slightly less than what we've seen nationally, but in that same ballpark. But we expect growth in Jefferson County to be very strong. We expect growth in Jefferson County to outstrip the state by far. We expect the rate of growth in Jefferson County to be more than double that in the West Virginia, in the state overall. We expect Jefferson County to even outstrip the nation as a whole. So Jefferson County is really blowing it out of the water. Berkeley County is going to grow a little bit more slowly, but by contrast, Berkeley County has had such strong growth over the past decade, nearly 2.5% annual growth over the last decade in Berkeley County. So kind of naturally, we expect some slower growth, but we expect Berkeley to still do well. Morgan County has actually declined a little bit over the last decade. It's been stagnant there in Morgan County, but we expect things to look better. We're actually calling for a 1.5% rate of growth in Morgan County over the last decade. So, a much stronger economy going forward in Morgan County compared to what we've seen over the last decade. There you see all three counties of the Eastern Panhandle are doing much better than the state overall. I will say there is some uncertainty. Some of the biggest sources of uncertainty are kind of with the hospitality sector overall there in the Eastern Panhandle, and with the casino. The casino over there in Jefferson County faces uncertainty, and that can affect the jobs picture. If the casino doesn't do as well as we expect, then then the overall growth is not going to be as strong as we expect. That should go without saying, but that's one important source of uncertainty. Here's the overall picture by sector now. Overall, we expect leisure and hospitality to be the fastest growing sector in the Eastern Panhandle. Again, that's different compared to the state overall. I was just talking about the trouble in that sector statewide, but we expect a pretty strong rate of growth in leisure and hospitality in the Eastern Panhandle. That's going to lead the way. Again, there's uncertainty around the casino and other areas, but we expect it's going to lead the way. professional and business services are going to do really well in the sector. In the region, I mean to say, information's doing well, manufacturing's doing well. All of those sectors are doing better than the overall rate of growth in the region. When you look at the Eastern Panhandle Economic Outlook report, it will walk you through step by step what's going on in each of these sectors with a more detailed analysis. And here's the unemployment rate forecast. As I mentioned before, unemployment is incredibly low in the Eastern Panhandle by comparison to the state, or by comparison to the nation even. And we expect that pattern to continue. We expect Eastern Panhandle to continue to have a really low rate of unemployment for the future. Doing really well in terms of unemployment. That's expected to continue to be the case. Oh, I forgot that I had this figure. I just showed this figure just to show the positive momentum there in the Eastern Panhandle. There you see the blue bars show you the population in the Eastern Panhandle, by year going back for over 2 decades. And then the yellow line shows you the population in the state. And boy, what a contrast. I mean, look at the decline in population that we've had in West Virginia for the past decade or so, and we expect that decline to continue for the next few years. But look at the contrast there with the Eastern Panhandle. Look at that steady and strong growth that's there in the Eastern Panhandle. That's just a real good indicator of the positive demographics that we have there in the Eastern Panhandle. We have positive natural population growth where we have births exceeding deaths. That's not the case statewide, but that is the case in the Eastern Panhandle. And just the in-migration that we have, right? It's just indicative of the positive momentum that builds on itself, that pushes the regional economy, forward, stronger. It's really good, and I'm really excited about this figure. I don't normally show this figure when I speak at other parts of the state, but I do show it to you guys in the Eastern Panhandle just because it illustrates that momentum that's such a cool part of what our economy is looking like. One more as well, just per capita personal income. Per capita personal income in Jefferson County is one of the strongest. I forget now, but it's one of the top 3 highest per capita personal income counties in the state. It's getting pretty close to the nation in terms of per capita personal income. Berkeley County isn't quite as high, but Berkeley's higher than the state average altogether in terms of income. So not only all this other positive economic data, but the income data for the region look good as well, especially for Jefferson County. The last thing I want to mention before I take questions and before I pass it over to Todd is remote workers. I'll stop my screen share because that word was all I have to show there to show. So I'll just show you my face, and you can make fun of my coronavirus beard while I'm talking here the last couple of minutes. But we have an entirely new type of economic development that's before us. Right, for the entire history of economic development, we focused on bringing in a business, and that business will bring jobs with it. That's the effort that we put forward here in West Virginia. That's what everybody does. That's just kind of the thing to do. So we focus on bringing in a business, and the business brings jobs with it, and that's fine. That's not going anywhere. I have no problems with that. I hope that we continue to push hard in that area. I think we will continue to push hard in that area. But now we have a whole different type of economic development to consider in addition to the traditional approach. The idea here is that we've learned that not everybody has to be physically present to work. A lot of people are working remotely. I'm looking behind me. This is my upstairs room. I'm working remotely right now. We think a lot of people are going to permanently work remotely. This is something that Andy referred to earlier in his part of the conference. So with the fact that we have a pretty significant increase in the number of remote workers, combine that with the fact that it's so expensive to live in many of our coastal areas and many of our big cities, combine that with the fact that we have a low cost of living here in West Virginia, combine that with the fact that the virus was most pronounced in our densely populated areas like New York, for example. Combine that with the fact that West Virginia is more rural, more spread out. We didn't have as much of the virus here in our state as what we saw in the densely populated areas. we really think a lot of people might start to reconsider their whole life. They might figure out that, well, I can keep my job in Texas or in Chicago or in the Northeast or wherever, but I can move to a place like West Virginia where I can have a much lower cost of living and where I can have a totally different lifestyle. Combine this with the fact that we have a lot of strengths to leverage, right? A lot of these remote workers who see coming on in the next few years are going to be kind of millennial people who really appreciate outdoor amenities and things like that. Combine that with the fact that West Virginia has unbelievable opportunities with things like whitewater rafting and mountain biking and rock climbing. We have a real potential to sell our state to remote workers. Low cost of living, outdoor amenities, high quality of life in many ways. We think we have real potential to keep doing the traditional economic development efforts, but to also bring in remote workers, and they can just keep their jobs wherever they live, and they can just bring that money to West Virginia and help boost the regional economy. It's a real big plus, and I think it's a real opportunity for our state, but we have to be diligent and seize that opportunity while it's here. I know anecdotally of, I think, 3 people who are moving to West Virginia right now, or who have moved already over the past couple of months, who are keeping their jobs. I know of one guy who works in Texas, in Austin, which is a booming area, but he's keeping that job, but he's moving to West Virginia. He's going to bring that money back with him and help boost our local economy. It's a real great potential. The downside is this is only relevant where we have good internet. Obviously, you can't be a remote worker without good internet. So the areas of West Virginia that don't have internet, this possibility is not an issue for them. This is not a possibility for them until they do get good internet. So that's the one limiting factor, but I think it is an exciting opportunity. Anyway, that's my comments. Economic Outlook report. Because of some issues with this pandemic, we are a little bit late on finalizing the Eastern Panhandle Economic Outlook report, but by the end of the day tomorrow, you'll get an email with a link to the Eastern Panhandle Economic Outlook report. So you'll have all that detail that underlies my presentation. Of course, I just skimmed over the big picture stuff, but you'll see all that detail by the end of the day tomorrow when you get an email to the report. Brian, do we have any? I didn't even look. Do we have any questions for me?
So one came in on chat. It's one that's kind of related to political economy, but I guess it's worth addressing to at least get one, perception of the state's economy and how the U.S. Electoral process might affect it. So it's under a Biden administration. Do you have an opinion on whether he will leave policies in place which seem to be working, or immediately initiate changes that will slow growth?
Oh boy, you want me to jump into politics here?
as gently as possible, I guess.
Yeah, Ms. Robinson. Wow, I don't want to jump into politics. I need more coffee to start talking about politics. First and foremost, we don't know if the Senate is going to be controlled by Republicans or Democrats. If the Senate is controlled by Republicans, then we're going to have divided government, and that's going to limit the amount of legislation that is going to pass. So honestly, I think that the effect of kind of a Biden administration is going to significantly depend on whether Democrats or Republicans control the Senate, and that's not going to be determined here for a little while yet. So I don't know. I mean, executive action is becoming. Thank you, Ms. Robinson. Yes, I appreciate you not being mad at me for not wanting to jump into politics, but executive, on the flip side, executive orders have kind of become a more important part of presidential policy in recent years compared to legislation, and we'll just see what Biden does with executive orders. It's hard to say. We have trade policy that's up in the air. Trump affected trade policy in various ways, and we don't know what Biden's going to do with trade policy. We have kind of climate or energy policy. We don't know what's going to happen there. It's very uncertain. We have uncertainty coming at us from all different angles, I'll tell you. Brian, was that the last one, or is there another one in Q&A?
We had one just pop in on Q&A, so I'll bring it to you. So it's regarding the remote work issue. So we agree with the potential for remote working, but how do we promote decision makers to institute improvement in Wi-Fi rather than building more useless roads?
Oh boy. So all these questions deal with politicians. Hey, I can't make any sense out of politicians. I can't make any sense out of why politicians do what they do. Uh, I mean, I think we need to start communicating. So just real quick, I want to pass over to Todd in 1 minute. But real quick, when electricity and indoor plumbing first became a thing, they were considered luxuries, right? If you look back to the early 1900s or whenever, electricity and indoor plumbing was not considered to be a necessity. It was considered to be a luxury item for the rich. But over time, as we evolved, we just started to view electricity and indoor plumbing as an absolute necessity to life. We went from being a luxury to a necessity. Nowadays, if you don't have electricity or indoor plumbing, you're basically considered homeless, I would think. But I think that we're going to have to do the same thing with internet. When the internet came online in the 1990s, internet was a luxury. A lot of people didn't have it. It was just kind of a special thing for a few people here and there. But now internet is absolutely essential to economic development. You can't develop a region without internet. It's as simple as that. People won't move there. Not much is going to happen unless you have good internet. So we're going to have to start just changing the way that we think about internet, and we're going to have to start getting politicians to understand this, to think of internet as a necessity. Make that evolution happen just like it happened with electricity and indoor plumbing years before. Again, thank you all so much. Really appreciate your attendance here at the Eastern Panhandle Economic Outlook Conference. And right now I'll pass it over to Todd Hooker, who I mentioned before, is the Deputy Executive Director in the West Virginia Development Office.
Thanks, John. Can you hear me?
Yeah, I can hear you. You're coming through just fine.
Okay, great. I'm not going to take very much of everyone's time. Just kind of recap what the Development Office has done, particularly through the first part of the pandemic, what we're doing now, and the kind of things that we're seeing. So for those of you that don't know, I am the Deputy Executive Director. I'm tasked primarily with working with the group of folks that we have in the Business and Industrial Development Unit of the office, which, as the name implies, we interface a lot with larger corporations. But, in West Virginia, that same group of folks also works with companies that are considered small businesses. So during the first, I'd say 60 to 90 days of the pandemic, our existing industry team that are reps assigned regionally in West Virginia was tasked primarily working with what I would call non-traditional clients of ours. Normally, we work with manufacturers, higher impact service businesses. We don't work a lot with what I would call the Main Street retail type of businesses. We have a separate small business division in the office that does that. But for the first 60 or 90 days, those folks worked with local and regional partners, linking businesses and individuals to various federal stimulus programs that were being administered. So it was a very unusual occurrence, as everyone knows. I mean, normally when we're dealing with a disaster, it's a physical, natural disaster like a snowstorm or a flood. So I characterize the problem that we had in the service industry, retail, restaurants, these kinds of things, as it was a working capital disaster. I mean, no revenue coming in, people depended on those jobs for, their living, and it was a very difficult time. But couldn't be prouder of the team. They worked great with the local EDAs. You have a great representative up in the Eastern Panhandle, and Jim Linsemeyer. And I know Jim was busy linking people with various resources through the whole thing. We saw a mix on the industrials early on. Some of the automotive related projects that we have throughout the state had furloughs. I would say after Memorial Day, middle of June, they started calling people back, so it was temporary. We know from the past that, in recession environments. Automotive falls off pretty quick, takes a little longer to come back while we wait for consumers to get confident again on major purchases. But we also saw some things move forward, and John mentioned it, notably for the Eastern Panhandle. The Clorox project had been announced in Virginia, I think last year, ran into some problems, and we worked with them, announced the project in the winter before everybody was sent home for the pandemic, and we continued to what I call paper the project, execute agreements, and they're moving forward with that project now. But we've seen other sectors where transportation related, aerospace related, where the drop off in air travel has impacted some of our projects there. So a little bit of a mixed bag. What we see as a good fit for the Eastern Panhandle going forward would be information and technology projects, aerospace and defense related projects, and of course, consumer products and e-commerce. I think you guys know a lot of the key advantages for the Eastern Panhandle are, number one, the location to the Northeast and Mid-Atlantic markets, but I think another big advantage both panhandles have in West Virginia compared to Charleston or Huntington is when you draw a 50 or 75 mile circle as you're making a location decision and look at labor demographics, the Eastern Panhandle really stands out for us as a shining star. It's just a bigger universe of people, and what that translates to for consultants and prospects is confidence that we can deliver the labor. I do understand that labor in the Eastern Panhandle tends to tighten up before it does anywhere else in the state. But from my perspective, that's a bit of a good problem to have. There's so much activity up there. The things driving, I think a lot of the interest, again, on 81, people want to be on or adjacent to Interstate 81. If you think about it, it is the main logistics corridor for the Eastern United States now. We see a tremendous amount of interest in that region for manufacturing, and it runs the gamut from building products to consumer products like cleaning goods and food related stuff. Berkeley County with the Procter & Gamble project, it just keeps growing. To give everybody a little bit of perspective, when the project was announced, P&G had agreed to 600 jobs and about $500 million of investment. I won't get into specific investment numbers. We do know that it's far exceeded the $500 million that they announced, and they employ directly themselves now 1,400. So that's not counting at least 2 suppliers on the site and probably a couple hundred contractors running around too. So great news for the Eastern Panhandle. I think we're just at the beginning of, I won't say the beginning, but I don't think P&G has reached full capacity yet. So we expect the facility to continue to grow employment-wise. We still see periodic interest from various kinds of suppliers that want to be close to P&G. They don't necessarily have to be right in Berkeley County, but a lot of interest around the facility. The Rockwool project keeps going. They expect to be producing stone wool insulation out of that facility by first quarter of next year. And of course, Macy's.com right now is getting to ramp up for its biggest season of the year, which is Christmas. I did not know they have 2 peaks. One is apparently bridal registered in the spring. So from a new project perspective, I will say that deal flow for the Eastern Panhandle compared to most of the rest of the state is what I would say is robust. Now, what we're seeing, I think probably the election does affect decisions in the short term. I mean, I think there's kind of a dead time between elections where people are assessing what to do. But from what we've seen here at the development office, I'd say mid to late third quarter of the year, this year, we saw a real uptick in both expansion projects in the state and also new inquiries from directly from corporations and site consultants. So I told you about the existing industry team. We do have a sales team here that goes out and looks for the next Procter & Gamble or Macy's. We remain very engaged with various corporate real estate firms and site consultants. I think it's a fair assumption to say that the Eastern Panhandle, with that group of people, for the demographic reasons alone and location, the Eastern Panhandle, in particular the three counties, get an inordinate amount of those kinds of looks on like what I would characterize as larger projects, because another reason is your topography is much easier than the lion's share of the state. So, you know, we've had some great announcements throughout the state in the last couple of months. We have another one coming later today. Can't tell you what it is, but it should be public at about 1 or 2 o'clock. It's not in the Eastern Panhandle, but it's a good manufacturing project. And, you know, I can't emphasize it enough. The deal flow in the Eastern Panhandle keeps us pretty busy. We are seeing some more tech interest in the Eastern Panhandle. John hit on the remote worker angle. You know, broadband development is a priority for the state. As everyone can imagine, it's a pretty big job. But I know that here at the development office, Mike Graney, also Secretary Gonch, and in the governor's office and legislative leadership understand the broadband development is a super high priority for the state. And I think you're going to continue to see announcements about broadband development throughout the state. So Klockner Penoplast had an announcement of an expansion of a plastics project in Raleigh. I went mute for some reason. The Bombardier was bought by Mitsubishi Heavy Industries, a Japanese company. They recently announced 240 new jobs at the Benedum Airport in Harrison County. So I just wanted to give you a brief overview of what we're seeing. We do anticipate that the winter, you know, not to go all Game of Thrones on everybody, but winter is coming. And we do expect that there's going to be a pretty big impact with the same kinds of businesses, Main Street types of businesses that we saw early pandemic. What that looks like, we don't know. What the federal stimulus may look like going forward, we don't know. I would anticipate that there will be some, but again, you know, what it looks like is anybody's guess at this point. But there's a lot to like about the Eastern Panhandle, and I would say the deal flow remains robust. And I think, you know, it's corporations taking a look at where they are now and, you know, making a bet on when the pandemic or when the pandemic's going to end, when vaccines are going to be readily available, and hopefully we'll have more good news coming. I think everybody saw the announcement about Hyperloop in Tucker and Grant counties. I know that they intend to hopefully start moving dirt second half of next year. Our office is working directly with them on supply chain issues. We're keeping, you know, at some point they're going to do a supplier fair. We think there's going to be a great opportunity for small and medium-sized businesses around that. And if you think about Hyperloop, think about it kind of in terms of this could be like the Cape Canaveral of this kind of travel. So a lot of good things going on in West Virginia. It was a rough March, April, and May, but we're coming out of it a little bit. And I would agree with John's assessment. We've been pretty busy in the development office with new and expanded projects since late July, early August, and it's a good problem to have in our business. Certainly preferable to the alternative, but that's kind of how we see it. I mean, the future is really bright in the Eastern Panhandle. There's no question about it. I've worked extensively up there in my career. It just sees a lot of interest. So I hope that was not too general for you, John, but that's kind of what we're seeing right now. So everybody knows our office interfaces with John and in the business school all the time on mutual like research projects and and this kind of thing. So I think we have pretty good connectivity with the university now. We meet twice a month and discuss various issues. So with that, I will take any questions that anybody might have of me.
Todd, I thought that was really good. I really appreciate you coming on. I know you've been with us before here, and I always appreciate it a lot. We're right at 10:30, but I've got one question for you right now. We might just run 1 minute over. And I really like this question actually, because it kind of gives me kind of a sanity check. I mean, where are my numbers compared with what other people are thinking? So I appreciate this question. But here it goes. Jefferson County seems to be more data suggests that Jefferson will grow more over the next 5 years than Berkeley. What's your take on that? And if you disagree with me, I will not be offended at all. So be completely open in your answer.
Did you want me to take a crack at that, John?
You know, that was a question for you. Yes.
Oh, okay. I think, look, location. Jefferson County, in my opinion, it's going to grow. I think it's fair to have a debate about what that growth looks like. But, you really, I think about 50 or 60 miles from Washington, D.C. and the Beltway there. So there's going to be growth there. I mean, and again, I think it's fair to talk about what that looks like. I know that we have a great relationship with Dennis Jarvis there. It's been I think a pretty interesting couple years up there, I think it's fair to say. But Jefferson County is going to continue to grow. And I think the debate is going to be, what does that growth look like? And how can that growth fund the things that come with growth? I mean, managing growth is something that's it's a lot different than what we do in a lot of the rest of the state, which is we're trying to spur growth and see growth. And I think in the Eastern Panhandle, you have a unique challenge of managing growth. And it in a lot of ways is more difficult, because when you have a lot of people buying homes, they're going to put pupils in the schools, they're going to demand fire and EMS, police, these kinds of things, and that costs money. And I think John would tell you, typically houses and bedrooms aren't going to be enough to fund all the demands that come with population growth.
All right. Thank you, Todd. I was asked to repeat that question. Maybe my internet paused or something just real quick while I was reading that question. I'm just going to read it again, just to kind of close the loop back there, even though you've already provided your answer. I just don't want to ignore that request there. The question, just to tie up any loose ends, the question verbatim was, Jefferson County seems to be more anti-business than Berkeley, yet John Deskin's data suggests they will grow more over the next 5 years than Berkeley. Is that what you think too? So I'm sorry if my internet kind of glitched out when I was reading that the first time. But anyway, we're a couple minutes over, so everyone, really appreciate that. Really appreciate Andy and Todd. Really appreciate my team, Brian Lego and Dallas Mullet, for being here to support as well. Again, really want to be over there in Martinsburg and Berkeley Springs in person next year to see all of you folks face to face next year. And otherwise, thanks so much. Have a great day.
Thank you, John. Thanks, everyone.